good morning. You're watching The Market right here on 18 Hour with me, Aisha Faridi. Got Shrishti Sharma, Snehi Shah as well on the show with us. And, well, what a market it's been. Last week, we made it finally back to that 25,000 mark, that big bazooka from the RBI, that 50 bips cut, the most aggressive that we've had since the COVID era, definitely cheered sentiment on the street. We will, of course, talk about the trickle-down effect of that mega move. That's going to be quite long-lasting for times to come. But yeah, what really kept us busy all weekend was the kind of spat that you had going on and got quite ugly, in fact, between Musk and Trump. So that breakup has happened for sure. And on the back of that, you've got U.S. futures. Right now, of course, they're trading pretty steady ahead of all that crucial data, which is, lined up for the week ahead. You've got all eyes now on the U.S. China trade talks in London, what's going to transpire on that. The jobs data came in. You had a strong handover coming in on Friday because of that. Just want to mark how the markets shut shop there. And a solid 1 to 1.25% move is what you had on the global markets or U.S. indexes overnight. So clearly trade optimism, jobs data, all of that was fueling the sentiment. In fact, the S&P 500 index managed to cross the 6,000 mark for the first time ever. So suffice to say, pretty much the U.S. equity markets are holding out very, very steadily. But yes, there was a sharp rebound in Tesla as well. That also helped Philip Dow in NASDAQ. So the spat between Trump and Musk that didn't quite trickle down into the equity markets for sure, barring that knee-jerk reaction that you had earlier last week. But yes, that said, let me quickly take it across to Ashesha as well. A lot of global commentary, a lot of data points as that 90-day tariff deadline approaches. Ashesha, what's the global commentary like?
Well, yes, first up, let's put the spotlight on the commentary that has come in from Philadelphia Fed, where he says that May jobs report was very solid. Firms want policy uncertainty, but firms are not getting that policy uncertainty as yet. Fed policy is moderately restrictive and they are taking preemptive action would be a mistake. So some important commentary that has come in from Federal Reserve over here. Apart from that, Citi equity strategists have come out with a report where they say that they are raising their year-end S&P 500 target to 6,300 versus 5,800 earlier. They see structural bullishness from here on. In fact, it's a detailed report where they say that U.S. large cap stocks are likely to outperform. More constructive fundamental view is what they have on the U.S. equity markets. There is no doubt that there is policy uncertainty, policy volatility, which is likely to persist as we go forward. And this keeps them a little cautious at this juncture. In fact, they've also said that their bull case target is 7,000 while bear case target is 5,200. So this is the report that has come in from Citi on global equity markets. Shifting focus to some commentary that has come in from ECB. Where they say that they are no longer constructive. They believe that we can now take time to look at the situation first and we have maximum flexibility at this interest rate level. Some important commentary that has come in from ECB as well. Shifting focus to some commentary that has come in from the Chancellor of Germany, where he says U.S. tariffs are threatening German economy. In fact, he goes on to say he emphasized renewed sense of dialogue and a clear American commitment to NATO. He continued and he says that they are pledging nearly 5% of their GDP to Germany's defense budget. So these are some of the important commentaries that have come in from global markets.
Thanks so much for taking us through that. While we are talking about some important news and updates and important commentary coming in, we do have a statement that's come in from Donald Trump wherein he said that he expects the meeting with China today to go very well. Now, from reports we understand that there is a delegation of the US and China that are going to be meeting in London to discuss the next round of trade talks. So that's going to be a very closely watched event today. We have Adrian Mowat, the EM of Equity Strategist, joining us on the show today. And Adrian, hi, morning. Thanks so much for joining us. Give us a sense of what we can expect to hear from this meeting. What could be the possible talking points on the agenda today? Do you believe that this rare earth metals issue could finally be addressed today and we could have some clarity there?
I'm not overly optimistic about the meeting between the US and China. The Chinese are very well prepared for the trade dispute that's in place. I don't think they're going to sort of roll over and give significant concessions, particularly around tariff levels. There may be a few token concessions with regards to non-tariff issues like restricting rare earths. And, as I look at capital markets, which essentially seem to have priced out any trade dispute now and have a very sort of optimistic outlook, I would tend to be a little bit more cautious about risk assets when they're taking such an optimistic view. And, I go back to this, the Chinese are very, very well prepared for this dispute with the US. And it's not in their interest to give concessions that are one-sided. So I think these negotiations could prove to be pretty tough.
All right. Adrian, also give us some sense that how do you see the fund flow shaping up between the U.S. markets as well as emerging markets? Because for U.S., we do see a strong May jobs data, the trade talks are on, while for the emerging markets, because of the rate cuts, some of these emerging markets are having that fillip, including India.
Yeah, so the labor market data looked good, but then if you looked at the revisions, there was quite significant revisions down of job growth. And there was something like 300,000 layoffs. So we are beginning to see some evidence of a sort of weakening of the US economy. Now, with regards to fund flows, I think they're going to be quite favorable for emerging markets, including India. We have a weak dollar, and that gives flexibility, and the RBI highlighted that flexibility with a 50 basis point cut in interest rates in India. The INR, which had been relatively weak up until a few months ago, is strengthening in line with other currencies that are strengthening versus the US dollar. And I think this puts emerging markets very much back in favor again. And India, as one of the major emerging markets, is going to be a beneficiary of that, as will China and as will Brazil, etc. And when I think about this situation, if we can have a US economy that's slowing, a weak dollar, and the rest of the world sort of doing okay and sort of managing around these trade disputes, then I think EM equities do very well. I'd also highlight, when you think about flow of funds, we've lived in a world where dollar assets have been favored for many years. Many investors have sat with unhedged positions along US dollar assets. Their lack of hedging is a problem now, as when they convert their gains into their own currency, it's much lower because their currencies are appreciating. So I think the flow of funds out of US assets has really just started. Again, that will favor emerging markets, both for debt and equity. I would also highlight that, when we look at the tariff story and this trade dispute, we're sort of focusing on that too much, and we're not focusing enough on how serious fiscal positions are in the developed world. And the issue with fiscal positions is this movement away between a primary deficit that doesn't look too bad, but a rapidly expanding secondary deficit. And what that means is, because the price of money has gone up, borrowing costs have gone up, and the level of debt has gone up, that the real fiscal strain is the interest burden. And we need to see fiscal reductions. We've got to see less spending, more taxes in the United States, to a lesser extent in Europe, maybe more concentrated places like the UK, where the fiscal position is weaker. Again, I think that makes emerging markets look more favorable because they don't seem to have the same stress. India's cutting rates, China's been cutting rates. So I think there's a very nice setup in place here. I think we're going to get a better opportunity, though, to add EM risk, because I do expect these trade deals to prove more difficult between Europe and the United States, and between China and the United States, and that might provide an opportunity to add more risk in EM. But I'm pretty bullish about the EM story.
I was just going to come to what you were talking about, Adrian, when we started off your answer. You were talking about what the central bank positioning has been. And just this week, you've got the BOJ, the ECB, the BOE, all their representatives speaking. I'm wondering, at a time when pretty much all central banks are easing rates, why is the BOJ and the Fed still holding fire?
Yeah, so I think the BOJ, remember, the BOJ is trying to tighten monetary policy, not loosen monetary policy. And I think there's good arguments for them to be cautious in tightening policy, as there's already an implicit tightening in the fact that the yen has been appreciating versus the US dollar. The Fed, we were referring earlier to the job data. The US economy is still expanding, and inflation still remains high. And the impact of the trade dispute and higher tariffs, and remember, we've got a flat 10% tariff on all imports coming into the United States. The Fed is understandably cautious about the inflationary impact of that. But let's go back and think about this move from dollar assets, from US equities, US bonds, into other assets. If I've got the I've got the European Central Bank cutting rates, possibly Bank of England cutting rates. We've got easing in the major EMs, whether that's India or China. That all makes these other markets, these other assets look a lot more attractive than having US equities, US bonds.
Okay, Adrian, point taken. Thanks so much for joining us on the show and speaking to us this morning. Appreciate your view. But with that, viewers, while we were talking about central bank action, let's understand the implication of what we've seen on Friday. Remember, a 50 bips rate cut as well as a 100-point CRR cut is what we've seen. Now, what could these implications be? Our economy believes that the government and central bank are in tandem with each other. This offers near-term clarity on repo rate, and it also addresses domestic concerns because it dilutes the rate volatility risk for the bond market. If you take a look at the trend that's been going on globally when it comes to rate cuts, so far India has seen a 100 bips rate cut cycle in this calendar year. ECB 225 bips slashed in the last 12 months. Japan, they've hiked 25 bips in Jan. There's no been any rate cut after Jan, rather, when you talk about the Japanese markets. If you take a look at what brokerages are making of this move, Nuvama believes that this is a welcome move. This should aid transmission, and because the RBI is now seeing limited room for further easing, they have shifted their stance to neutral. And now if they're indicating that there is not going to be any more cut ahead, this may be one of the shallowest easing cycles we've seen, because remember, every time after rate hike cycle, we've usually seen 6 consecutive rate cuts of 25 bips coming each, which totals to 150 bips. This time, if the RBI decides to stop after 100 bips cut, that is why Nuvama believes that this could be one of the shallowest rate cut cycles and could be insufficient to buoy demand, fiscal demand as well as export tailwinds. They also believe that further rate cuts are likely, but we need to wait for further easing. While we are talking about what the implication, let's understand what the impact could be on NBFCs and MFIs as well, because these are some of the stocks that have done pretty well on Friday. Now, RBI has cut the qualifying asset threshold from 75% to 60%. In simple terms, this now means that their lending capacity towards microfinance has been reduced from 75% to 60%, which now means 40% of their book is open to lend to various other uses. So that is a positive coming in for NBFCs and microfinance institutes, and that is looking good for both of these sectors right now.
Well, yes, the financials have done very well in Friday's trading session. More than 1,000 points of gain is what we have seen on an intraday basis. When it comes to Nifty Bank, did shut shop with over 800 points of gain, and not just financials. Other than that, within financials, Gold Financials Company and some of these life insurance companies did very well. So let's see how the action pans out in today's trading session. But talking about Nifty, that seemed to be snapping its 2-week losing streak as well. What a gain in today's trading session. What a gain in Friday's trading session. We have seen more than 250 points of gain. The mid caps was seen to be gaining for the second straight week. Small cap index for the 4th consecutive week. We have seen the index moving higher, and realty indeed was the top gainer. Metal, of course, was up by 2% of the gain on a weekly basis, and PSU banks were also doing well. So across the board, it was indeed a cheer that we have seen happening. Followed by that, it was the FMCG pack as well that seemed to be snapping its 2-week losing streak. So all in all, It has been a great week for the markets, and yes, the major thanks to the RBI rate cut and the CRR rate cut that was announced. But with this, let's also welcome on board Kunal Bothra, who is live with us in the studios. And Kunal, hi, good morning. How are the market looking like? Because it's been a great Friday for the markets, but what do you make of today morning?
Yeah, great Friday, and I think something which we were wanting for the last, I think, 2-3 weeks, because the markets were stuck into a range. We were stuck into like a 500-point range on the Nifty, and a very tepid kind of an underperformance, I would say, for the banking index, for the bank Nifty. I think after Friday's move, we can probably expect that both these indices, the key indices Nifty as well as the bank Nifty, will probably have come out of a major consolidation as well as a breakout for themselves. What was also heartening to see is, of course, participation across the board, whether it was the realty index, whether it was financial services as a pocket, few power stocks which were looking attractive, the PSU theme which started to gain prominence. So I think that was a very strong indication. We also saw one sign that the defense sector or many of the defense stocks, they start to come back into a corrective phase, which means that the money would start to now get back into a sector rotation phase of trying to maybe book some bit of profits over there from a top performing sector towards other sectors which are showing signs of a potential breakout. So that's a sign of a healthy market where the money moves and there's a churn across the sectors. Net, I would believe that we should be looking at 25,250 as a target, potential target for the index in this week.
So, Kunal, what's it looking like? It was realty, banks, after that RBI, big bazooka, all of these sectors were chugging along nicely. Where do you think the money which is going to move out of defense, if it is a sustainable trend, that is, where is it going to find its way?
So I think banks and financials could be the pocket where the money should be moving out. PSUs as a large overall theme also, I think something which I would be bullish on from current levels. You saw many of the real estate stocks, and not just I think on Friday, but you look at the built up over the last 1 week or 10 days prior to that, DLF was looking strong. The stock managed to surpass the levels of 750, 770. Then you saw Oberoi Realty, Godrej Properties. Many of these stocks have actually started to look attractive in the last 7-8 days, and they got a fillip further after Friday's data point, and then a further price action move where these stocks managed to rise by a margin of 5% to 6% broadly, individual stocks. So I think that's another sector to look out for.
Okay, and Kunal, now that the markets have turned favorable in your view, what would be your stock-specific recommendations this morning? Would you be making bullish calls this morning?
Yeah, of course, you have to continue with the bullish calls. And now I think it's time to maybe look at rotating sectors. So, two stocks within the space which I would start to look a lot more bullish on. One would be L&T Finance. Now, I think after almost like 3 months or 2.5 odd months, the stock has managed to surpass the levels of 175 to 185, which was a major resistance for L&T Finance. So that's something which starts to look extremely attractive at current levels. Would look out for 198 as a target. Stop loss could be kept at 184. And the second would be a buy on REC Limited. This could be a more of a contra bet. And the stock in the last 4 or 5 months has been a huge underperformer in the PSU as well as in the power pack. So I sense that the stock would make an eventual comeback. Would be bullish on REC with a target of 440, stop loss at 406.
Okay, L&T Finance, REC, clearly a financial tilt to Kunal's recommendations this morning. Let's take a very quick break. Before that, let's see what the implied open is. 25,100 seems to be getting here. In fact, 25,200 seems to be inside right now. But all this after RBI's surprise move, which has gone ahead and cut the CRR, that is the cash reserve ratio, by a good 100 basis points. Experts say that this is a rather welcome move and touch upon their impact of this on the liquidity boost. Hear out some expert opinion.
The Reserve Bank has front-loaded quite a large cut in repo rate and also larger cut in the CRR. That is, they were going to really mention that he is front-loading the whatever possible monetary policy and liquidity action that Reserve Bank can take. And he also cautioned that this is the thing that we can do. Hereafter, heavyweight will have to be taken by implication by fiscal policy.
CRR reduction of 100 basis point will certainly help in terms of America's cost of funds. It will certainly improve the cost of funds. What will happen is that when this transmission really happens, so actually speaking, there would have been a pressure on the NIM. So I think with this reduction in the CRR by another 100 basis point, It will actually help the banks in protecting their NIM also.
Now we are probably at the stage between RBI OMO, the dollar swap, and the RBI dividend and CRR cut. About 12 lakh crore of liquidity has been imparted into the system. So we will see first parallel move down on yield curve, then short yield curve coming further down, and eventually long end of the curve also coming down little bit.
If Nifty is indicating a gap up start for the Indian markets, and the key to watch will be financials, how they actually go ahead and follow up on Friday's move. But after other than financials, a lot of stocks will be in focus on the back of the news flow. So let's go across to my colleague Varun, who is standing by with a list of stocks that will be in focus today. Varun, good morning. Over to you.
Good morning, Shashi. So let me start with the financials itself, because the gold financing companies, the RBI has actually notified the directions for lending against gold and silver collateral. So the maximum LTV, it would be capped at 85% for loans up to 2.5 lakhs. From 2.5 to 5 lakhs, the LTV is capped at 80%, and above 5 lakhs, the LTV is capped at around 75%. So keep an eye on these stocks today also. Keep an eye on RITES and Hindustan Copper, because they have signed the MOU to jointly develop a supply chain of metals and minerals, including critical minerals in India and also overseas market. Railtel, the company has received work order worth rupees 259 crores. Bajaj Finance, the record date for the purpose of bonus and stock split has been announced, and the date is 16th of June. Keep an eye on BL, because BL and Tata Electronics, they have done a MOU basically in the semiconductor field. So keep an eye on BL. MCX, the company has received approval from SEBI to launch electricity derivatives. So this is an important development. So keep an eye on MCX as well. Infosys, the company has actually cleared around 32,400 crores of GST case. So basically this was regarding a show cause notice which the company has received for assessment year 2017-18 and also from 19 to 22, and that has been cleared now. So it's a big relief for Infosys as well. Keep an eye on Lupin, because the company has received U.S FDA approval for oxybenzepine tablets, and this tablet would be manufactured in Nagpur, and the overall annual sales in US for this product was actually $206 million. And last but not least, keep an eye on Greaves Cotton, because India ratings have actually downgraded the rating for this company to AA- stable.
Thanks so much for taking us through all of those stocks to watch out for in today's trade. But while we are talking about which stocks are going to be in focus, joining that list is going to be Tata Steel this morning on the back of their FY25 annual report, wherein they have outlined aggressive capital and cost strategies. The capex is pegged at more than 15,000 crore rupees for FY26, with 75% of next year's spend focus on India. Debt reduction remains a priority, and transition plans in the UK and Netherlands aim to boost efficiency and sustainability. Ashesha is joining us with the key highlights of this annual report. Ashesha.
Well, yes, Tata Steel will be in focus today, and this is because the management has reiterated their capex, cost reduction and deleveraging plan for the next few years in the annual report that they released over the weekend. And first up, let's talk about capex. Remember, they incurred capex of about 15,670 odd crores in the year gone by. They are planning 15,000 crores of capex for this year as well. 75% will be for India operations, and the balance 25% will be for European operations. Now, as far as capex plans in India is concerned, remember they are looking to expand their Kalinganagar facility, EAF project in Ludhiana, and Neelachal Ispat, their recent acquisition and its growth plans will also be on company's radar for the next few years. So these are the major capex plans that the company has for the next few years. As far as cost reduction program is concerned, remember the management had highlighted this in the earnings call after their Q4 results, where they said that they reduced costs by about 6,200 crores in FY25. They are planning to reduce their cost by another 11,500 crores in FY26 as well. This will be across their operations, both India as well as Europe, which includes UK as well as Netherlands. Now, as far as deleveraging plan is concerned, remember they reduced debt by about 6,200 crores in the second half of FY25, and this is likely to continue going forward as well. Remember, They've not given any figure or debt reduction target, but they say that increasing cash flows will help company lower the debt going forward. As far as UK transition is concerned, they've given a proper timeline where they say that 2 blast furnaces at Port Talbot have already been decommissioned. Construction of the EAF plant is likely to commission next month, that is in July 2025, and the plant is likely to be commissioned in 2028. So they've given a fair roadmap of where UK transition is headed, and as far as Netherlands transition is concerned, they are still in discussion with Dutch government in order to ensure smooth transition from the current manufacturing process to EAF. So they've highlighted their plans, capex and deleveraging plans, which look quite promising. And deleveraging continues to remain in focus with transition in both UK as well as Netherlands.
All right, thank you so much, Ashesha, for getting us the key highlights of Tata Steel's annual report. But moving on to another news flow, and the Indian government has imposed anti-dumping duties on imports of vitamin A, palmitate and insoluble sulfur from China, Japan, Switzerland and the European Union. The move comes to protect domestic manufacturing from low-priced imports that affect the local industry. Sharad joins in with more details on this one. Sharad?
A very positive development coming in when it comes to for the importers of insoluble sulfur and vitamin A palmitates. Now, India has actually imposed these anti-dumping duties, and this is for the imports of China and Japan when it comes to the insoluble sulfur imports and vitamin A palmitate from China, European Union and Switzerland. Of course, the DGTR action has come in, and these duties will be placed for the next 5 years. Now, insoluble sulfur is a very important component which is used by tire manufacturers to improve the rubber vulcanization, while vitamin A is actually used in fortified foods and pharma industry. Now, the duty change itself, the numbers for vitamin A palmitate, that has the range between 87 cents to almost $21 per kg. And for insoluble sulfur, the duty range is coming between $259 to $358 per metric ton. But the impact analysis is more important. Sulfur importers are tire companies. Apollo, MRF, JK Tyres, they are one of the largest importers of this product, and they are likely to benefit as the industry, the domestic industry, gets a push. Now, also in chemicals, it's very important, especially Oriental Carbon Chemical, Coromandel, PI, Navin Fluorine, and even Paradeep Phosphates. The numbers are, of course, ranging, but of course, the sulfur importers and chemicals also likely to benefit. And from the pharma space, two names are there: vitamin A palmitate imports, Piramal Pharma among the larger names, and in the smaller names, it's Fermenta Biotech. So these stocks would be in focus.
Okay, Shara, thanks for taking us through all of those details. Let's welcome on board Sandeep Sabharwal, who's joining us this morning. And Sandeep, hi, morning. Thanks so much for joining us, and lots of news flow to discuss, stock specific and otherwise as well. But let's begin by getting your view on where you see the markets headed today, the kind of fillip that we've seen on the Nifty on Friday. Do you believe that is sustainable today, and the sectors that have been leading over the course of last week, do you believe they'll continue to lead this week as well?
Yes, I think so, because the RBI actions were quite significant. And in fact, many other sectors like auto would also have participated much more, because they are very strong beneficiaries of the easing liquidity and rate cut cycle, but for the rare magnets issue. Otherwise, the autos would have done much better than what they did on Friday. And I think if that sector remains subdued due to concerns around these supplies and apparent shutdowns, etc. So I think at that time we could get opportunities to buy these stocks. Otherwise, what RBI has delivered, combined with the kind of tax breaks which the government has given for the middle class this year, higher government spending, overall lower inflation. So I think it's a perfect combination for revival in economic growth. And as that plays out, market should also do well.
You know, Sandeep, the one point that I wanted to discuss is that this big bazooka that they've given, I mean, not just the policy rate cut, but even for the MFI sector, because this is one space within financials which did have quite a fair bit of stress. Tell me, how does this help the MFI sector, and would you be an investor here at all?
I think so. Most of the MFI focused companies are trading at somewhat distressed valuations, and There were two comments specifically. One that the RBI clearly stated that they see easing stress on the unsecured loan book. So that is overall good for the financial sector, especially for NBFCs and more specifically for MFIs. Although there would be some concerns related to some state governments bringing out new laws, etc., where I think some specific companies could get impacted. So that has to be more minutely analyzed. But that comment combined with the fact that MFI lenders have the ability to diversify into other segments and still retain the MFI categorization, I think that's a significant positive because then risk can be maintained better in the balance sheet. So I think overall it's quite positive for the MFI sector, even for the gold lenders where the norms have been eased. So I think something has been given to everyone.
Sandeep, if you can just highlight some of your top favorites within the financial space. Well, of course, it's not just the MFIs, the gold finances. It's actually great news for many of these stocks. But which are your top bets within the financial space?
I think the larger banks will continue to do well, which include ICICI, HDFC, Axis, Kotak, etc. I think some of the PSU banks could see a revival. So because of the sheer underperformance, we have actually recently added into SBI also in our portfolios. The other part which could benefit, obviously, the NBFCs benefit much more in a significant easing cycle than the banks. So NBFCs, people have a wide choice from what we ourselves own are stocks like Manappuram, L&T Finance, Mahindra Financial, Bajaj Finance, etc. among the NBFCs. But then there are others also which will benefit. So investors have a wide choice. But overall for the NBFC sector, this what RBI has been doing over the last few months is a much more significant positive than banks per se, because most large banks have 40-45% CASA deposits where the costing doesn't reduce so much immediately. And it's more or less fixed. Although most banks have cut rates by 25 basis points. But for NBFCs, which tend to be bulk borrowers, significant monetary easing is much more positive.
It's literally been not just a small nudge, but it also almost seems like a policy pivot from the RBI. Back to back, they've announced, and like Sandeep was saying, literally, that there is something for everyone out there from what the RBI has gone on announcing since Friday, since the policy outcome. But Chandan Taparia as well joins in on the show right now. Chandan, hi. Clearly, the flavor seems to be all financials. What within financials are you liking right now?
Good morning. Thanks for having me. So yesterday Nifty managed to hold about 25,000 marks on closing basis, and given the recent highest daily close in last 16 trading session, and Bank Nifty outperformed, it made the new lifetime high at 56,695, and the clear outperformance is visible in this rate sensitive index. Entire BFSI segment looks quite promising, and we believe that buying interest could continue. We are positive on the most of the banking, financial, PSUs, and apart from that, real estate and other auto ancillaries could be in focus. If I have to take one name from banking space, then I'll focus on counter like private bank on Axis Bank. So after the corrective move of last 8-9 days, it took support at 50-day exponential moving average and formed a strong bullish candle. So expecting recovery in the counter with support of 1175, Axis Bank can head towards 1230 kind of level. So I believe Axis Bank could continue to see the buying interest, and Bank Nifty has potential to rally towards 57,250 to 57,500 marks.
Chandan's preferred picks and Axis Bank emerging over there, and as well as the levels that he's watching out for Nifty Bank as well. But let's understand why the entire financial space could be in focus yet again, because in a significant regulatory shift, the RBI has revised the qualifying asset criteria for NBFC MFI by lowering the minimum requirement for qualifying assets from 75% to 60% of total assets net of intangible assets on an ongoing basis. Now, what does this mean for NBFCs? Varun is here to break that down for us. Varun.
Definitely, it's a good step by RBI because the RBI has actually revised the qualifying assets criteria for NBFCs and microfinance. And this has been actually reduced from 75% earlier to 60% now. And under the updated framework, the qualifying assets are basically defined as collateral-free loans extended to households with an annual income of up to 3 lakhs. And any NBFC or microfinance breaching the norms for 4 quarters must submit a remediation plan to RBI within 4 months. That is what the guideline says. Now, how will this help the overall MFI sector? Now, this move will actually help the microfinance sector to diversify and expand into other assets and also improve the overall financial position of the microfinance sector. It will help improving fund availability to the microfinance sector and will also ensure balance sheet stability. This move will also position the MFI sector for better positioning for cross cycles earnings as well. If you remember, during the RBI press conference, the RBI has said that the overall stress in the personal loan and credit card segment has abated, but the stress in microfinance sector is still there, and this move will actually reduce the overall stress in the microfinance sector to some extent because the qualifying assets, the criteria has been reduced from 75% to 60%. So this is a welcome step by RBI on the microfinance sector.
All right. Thank you so much, Varun, for getting us all those details. So microfinance sector, let's watch out for that. And within financial, Sandeep did highlight some of the stocks that you can watch out for. But other than that, within the metal pack, all eyes will be on Tata Steel as well. The company did come out with their annual report and some of the key highlights as well. And in Friday's session, we have seen a good move on the metal counters as well. So Kunal, if you can quickly help us with the chart check on Tata Steel. And apart from that, if you can also give us a take on JSW Steel, which was indeed one of the top gainers in Nifty 50 on Friday.
So I think broadly, Tata Steel is one of the better performing stocks. JSW Steel actually has been an underperformer. In fact, there was this news flow for JSW Steel a couple of months back. Post that, we've actually seen the stock being a huge underperformer. It's not participated in the manner in which you would probably have expected many of the steel stocks to participate. And I think my sense is that we are looking at a different phase for many of these metal stocks. Now, broadly, I think even the likes of JSPL, Hindalco, they've started to show signs of some stability for themselves. The only underperforming stock from the pack, which still looks like a huge underperformer, has been Vedanta because the stock has been reeling under some extreme selling pressure. I think we've seen more or less 450 acting as a pivot for Vedanta, and the stock tends to fluctuate 20 points plus minus this 450 band. So I think that could be a underperforming stock over the near term unless the stock breaks past our 475 mark. But I think out of the pack, Tata Steel seems to be the strongest and the more formidable chart, and then followed by SAIL, as well as now new emerging candidates like GSPL as well as Hindalco.
Well, Sandeep, given that the RBI rate cut is also going to translate to lower EMIs, tell me within the realty pack, where is it that you find comfort to buy a fresh or add in, or even some of the, HFCs, for instance? Maybe that's a better play.
I like diversified NBFCs better, so I think I would focus on those because only focused housing finance companies will continue to face more and more margin pressures as the liquidity eases. So I think it's better to be in the diversified space. On the real estate sector, obviously this benefits the real estate sector. But as of now, I'm not finding comfort in buying into any of these real estate companies at these valuations because the run-ups in in the near term has been very substantial. Be it the market leader, like something like DLF already valued from 600 odd to I think 850, 880 something. So I think the rallies over the last 1 or 2 months in most of the real estate counters has been so significant. It's tough to find value, but on correction we could still evaluate.
Of these real estate names, but I also want to get in your view, Chandan, on some of these railway counters, because fundamentally we're seeing news flow coming back. Take for instance, RITES on the back of its MOU with Hincopper, Railtel in the morning they've announced 2 significant order wins. Fundamentally, this sector seems to be picking up, but is that momentum reflecting on the charts as well?
Are in buzz from last almost 8 to 10 days, and longs are being built in the counter, which are in FNO, and case counter are adding higher delivery volume. So positive momentum, I believe, could continue. In fact, the Nifty CPS index started to outperform, and counter from PSU, railway, defense are getting some buying interest. So to start with Railtel, I believe positive bias could continue here. The stock has really seen the good momentum in last 4 to 5 weeks, has been making higher tops, higher bottom. However, on Friday it remained consolidative, but major trend of the counter is positive. So with support of 432, one can look for an upside target towards 465. Looking at other name like RVNL, here we have seen a price formation similar to pole and flag, and a small momentum could give the fresh leg of rally in the counter. So with support of 418, one can look for an upside target towards 450. So I believe most of the railway counter could be in focus in RVNL, and counter like Railtel could be in focus to get the buying interest at current juncture.
All right, so that's about select railway counters. But other than that, within this pack, all eyes will be on RITES as well, because RITES and Hindustan Copper has signed an MOU to jointly develop the sustainable supply chain of metals and minerals, and that will include the critical minerals in India and overseas as well. But Sandeep, just wanted to have your take on this one, because yes, between both of these two companies, the MOU has been signed. It is a long process where both the companies will actually see what they can do best. But it's a big issue that is now emerging for the auto companies, specifically with the shortage of critical rare earth magnets coming in from China. What's your sense that how severe this could actually impact the Indian auto industry and other sectors as well, given the fact we have a lot of reliability on China when it comes to select magnets?
So I think there's a lot of news flow on where the impacts could be. I think the direct impact is more on the auto side immediately, but apparently these go into a whole host of electronics, etc. So now it will depend on how fast. So it's not a question of supply. The supply is there. The supply is not been given. So that is the issue. So whether it will get resolved or not, we don't know. Overnight, there's been some news flow that China has approved supplies to some European and U.S. customers. So the point is India going to be singled out, or is this issue going to be resolved? So I think there are too many moving pieces. So we need to watch out for that. EVs apparently will be much more impacted. So to that extent, companies which have bigger EV portfolio or a greater reliance on EVs only, or two-wheeler EV companies, etc., those might be impacted more if it doesn't get resolved over the next 4 to 6 weeks.
Okay, that's that on the rare earth magnets issue. Let's see how it transpires, given that China and US are going to be talking in London. So let's see whether something comes out of those trade negotiations or not. But back home, in what perhaps could spell trouble for HDFC Bank, the Mehta family of the Leelavati Trust has filed an FIR against the MD and CEO Shashidhar Jagdishan and called for his suspension and allegations of fraud linked to the trust. What exactly is happening here? Ankur is here with that detail. Ankur?
Yes, first of all, HDFC Bank has denied all these allegations which are made by the Mehta family and the trust, saying that these are malified attempt not to pay up. In fact, the bank has been in discussion with the Mehta family for over 2 decades for recovery, and all these legal angles have been taken by the family not to pay to the bank. But if you talk about the trust, they have made allegations that MD and CEO has actually received over rupees 2 crore just to target these family members. And remember, there was a misappropriation of funds which has been alleged by the trust, and this battle has been ongoing for a while, because there are 2 factions, and while Prashant Mehta faction is alleging that earlier Mehta brother had been involved in the fraud and there was a problem, and even HDFC Bank MD and CEO was involved in that. HDFC Bank has actually clearly denied all these allegations. In fact, they have also mentioned that even Supreme Court has cleared them off because the matter had reached there, and this matter involves a recovery of over 60 crore, which bank has been engaging with Prashant Mehta and family earlier.
The take on HDFC Bank, the stock could see a little bit of a trouble on market open today. But Kunal, what's your view when it comes to HDFC Bank? It's been largely a laggard when it comes to its overall contribution to Nifty. Where are you seeing this stock headed? Because it's been a very slow mover.
Yeah, it's been a slow mover. It's been true to its nature, a high weightage stock, but then a low beta, nature move for HDFC Bank. On Friday, I think if I'm not wrong, the stock was in touching distance of breaking past about the 2000 levels. Came very close towards making an all-time high levels. I'm not sure whether the stock closed at an all-time highs, but I think with the move which the stock has shown in the last 3 months or so, a gradual uptick first from the 1750 levels, then being one of the better performers in the private sector banking names, and then going through a patch of 2-3 weeks of consolidation. I think all of that it just about seems to indicate that this is a good stock to hold on to from a medium to long term play, because we've seen that HDFC Bank largely has not participated in the last 2-3 years of a major cycle where the Bank Nifty had started to look attractive. So you can't leave out HDFC Bank when you're looking at a major revival cycle for the banking index and the Bank Nifty overall for the next, say, many quarters or for the next couple of years. So I think in that aspect, the stock should be a steady performer going forward.
Sandeep, in your own words, you've talked about as to how the picture is looking perfect right now, right? In terms of cues and a fillip to consumption, everything from lower inflation, lower EMIs now, interest rates on all kinds of loans, lower taxes, and good monsoon as well, and an early onset at that. We've discussed autos as well as homes, but what others could be the trickle-down effect of a consumption fillip if it were to come in, given that the combination looks picture perfect right now?
I think lower interest rates like these directly benefit infrastructure construction companies, and I believe that many of those stocks are still significantly below 52-week highs. So I think that is one sector which definitely benefits due to easing liquidity and lower interest rates, because their clients can fund more projects, their balance sheets which have debt, the rates get reduced. So I think that's one sector. And secondly, there'll definitely be a revival in consumer durable demand as we go into the festival season this time, because it's been subdued for 2-3 years. And I think with this kind of combination, there has to be a revival. So I think all the consumer durable names could see an uptick going forward.
All right, but Sandeep, also give us some sense that how do you see the latest news flow on MCX and how can this actually impact the fundamentals of the company as the company announces the launch of equity derivatives where they will generate contracts to generators, distribution companies and large customers to hedge against the price volatility and manage price risk by enhancing the efficiency in the power market. Give us some sense that how will it matter to MCX since the stock is already at an all-time high?
Yeah, so I think the exchanges have been moving up steadily across the board as the unlisted price of the NSE stock also keeps on moving up. So I think that's in line with that. Valuations obviously are excessive, but incrementally it's a positive move because it is a good segment to be in. I think electricity derivatives will only grow going forward as different sources of supply come in with varied supply intervals, like solar will be available only during the day, then there'll be solar storage also coming up. So I think that will impact how it behaves. So unlike thermal, which is a regular supply, all other sources of renewable energy have periodicity. So that will make the overall electricity trading grow. So whoever gets into this segment has to be a beneficiary. Initial contribution to the overall profitability, etc., might be low, but it's a segment which could grow.
So much news flow when it comes to the defense pack, right? Even over the weekend, you've got news that BEL has inked that MOU with Tata Electronics now. They're looking to explore opportunities in area of semiconductors. There was also news on Garden Reach. They've signed an MOU with Sweden, with Denmark for now marine systems and cruise segment. But do you think that defense as a sector could perhaps be priced to perfection right now? Or do you think there's still value on the table?
I think money flow will continue into this sector because as an overall part of the market, this is still a small market. But that, like you rightly said, many companies have become very excessively valued, especially I think many of the shipyard companies or for that matter, many of the other defense companies, where some of these companies also have guided for just 7-10% growth, and then still the valuations have become 80-90 times. So it's and on the private sector side, the frenzy, whoever is related to defense, is even much more greater. So I think the valuations on the private sector defense companies have gone totally, completely out of sync with what the actual valuation should be. So I think people need to be careful. They need to time their entries, but participate in the defense theme, but at the right price, because we've seen that in the past, if you got in at the wrong price, sometimes these stocks could correct as much as 50% also if there's a correction.
That's Sandeep's take on some of these defense names. So while we are talking about Garden Reach, the stock is also going to be in focus today as the Indian Navy has commissioned the first anti-submarine warfare shallow watercraft. We will also look at some of the recent MOUs and the order wins that the company has secured so far. And Sharad is here with more details on the stock performance and the recent MOUs, the recent activity within the company. Sharad.
In focus is Garden Reach Shipbuilders, and a slew of MOUs and order wins have been announced recently. And of course, today the company will be in focus as Indian Navy is all set to commission the first anti-submarine warfare shallow watercraft. And importantly, the three MOUs and order wins which have been signed recently. The first one is an MOU signed with Burge Propulsion from Sweden and Sunstone from Denmark, and this is for marine propulsion systems. Another MOU signed with Sunstone Denmark, and this is to expedite the cruise vessels. Now, our company recently was an L1 bidder also for construction of next generation corvettes, with the value coming in around 25,000 odd crore rupees. Now, interestingly, the management spoke with ET now a week ago, and FY26 they're expecting to be a peak revenue year, while the momentum is expected to be strong for FY27 as well. A strong returns has also come in for the investors. Over the last 1 month, the stock has jumped 82%, and a year-to-date basis almost double, and 1 year basis it's up 150%. So a very strong rally coming when it comes to the shipping and the defense space recently, with the rise in geopolitical tension and India becoming a hotbed for exports as well.
All right, thank you so much, Sharath, for getting us all those details. But Sandeep, also help us with your take on GRSE, because yes, some of these counters have been doing well. But any take by you on that? How do you see the growth for the company as FY26 is expected to be the peak revenue year, while FY27 is potentially continue to see a strong momentum?
So while evaluating any stock, you have to understand what is built in and what is not built into the price. So I think many of these shipyard companies have run way ahead of fundamentals. So people need to be careful at what price they are buying. Directionally, the story for shipyards is strong, but then we cannot buy them at 80-90 P or any sort of absurd price earning ratio. So I think we need to be careful at what price we buy.
Sandeep, what do you think the texture of the market is going to be here? You know, we were just discussing the other day that mutual funds are still sitting on a whole pile of cash. The scenario right now is perfect for all that money to pour in right now, especially because of what's happening in the developed world as well. Do you think it's going to be more of an across-the-board move, across sectors, that we will see a move up? Or do you think it's going to be this versus that kind of move? And then what do you think is going to be the composition of where you see leadership and where you see underperformance?
I think it will be across the board because initially the direct beneficiaries of the rate cut cycle will move up along with the fancied sectors, and then there'll be a catch up of those sectors which have not participated also because there'll be a left out feeling among many investors. So I think it will be across the board. Some sectors which are direct beneficiaries of rate cut cycle policy changes benefit immediately, and for the others it will be more of trickle down.
Sandeep, good to have you on the show, and here's fingers crossed. The pre-open rates, let's see what they're indicating. I think we'll give them a skip. They will settle down. The pre-open rates itself, or rather the GIFT Nifty rates itself, were indicating some more upside for us. But that said, Kunal, where do you think leadership and weakness is going to prevail